Hey everyone, let's talk about the state of America's retailers. 1 in 10 retail companies is at risk of closure this winter as we enter another economic downturn. The data backs it up. We're seeing a growing number of businesses potentially defaulting on their debts, going bankrupt, or just closing shop for good. Remember Toys R Us? It felt like they were everywhere, and then suddenly, poof! Today we're diving into a list of 15 major retailers that are teetering on the edge. But before we get into all of that, give this video a thumbs up and subscribe to our channel. First up, we have Bed Bath & Beyond. Initially, they benefited from the pandemic as people focused on home improvement, but supply chain issues and rising inflation hit them hard. They're currently staring down a massive $1.7 billion debt load. The company has been closing stores and laying off employees to cut costs. Some analysts believe that bankruptcy is a very real possibility for Bed Bath & Beyond. It's a classic retail story of a once thriving company hit by a perfect storm of challenges. Will they manage to pull themselves back from the brink? Our next entry is Tuesday Morning, a home goods discounter. Their troubles started before the pandemic, with online retailers like Amazon cutting into their profits. The pandemic accelerated their decline and foot traffic plummeted. They filed for bankruptcy earlier this year, hoping to restructure. However, that plan hasn't gone smoothly and sales remain sluggish. Analysts now say there's a real chance Tuesday Morning won't recover and will be forced to liquidate. It's a sad end for a company that was once a beloved part of the retail landscape. It seems like every day we hear about another store closing its doors for good. Our next retailer is The Real, a luxury consignment marketplace. Despite early success, they've been plagued by controversy and mounting losses. Accusations of selling counterfeit goods damaged their reputation. They invested heavily in authentication experts and logistics, but those investments haven't translated into profitability. Over the past 12 months, they've racked up a staggering $100 million in losses. Analysts believe The Real has a 75% chance of bankruptcy. It's a cautionary tale about the challenges of building a successful business in online retail. Even with a seemingly winning formula, success is never guaranteed. Next up, we have Wayfair, the kings of online furniture and home goods. Despite being a go-to destination for online shoppers, Wayfair has been posting net losses every year since 2011. Selling large, bulky items online is more expensive than it seems. The pandemic-fueled surge in online shopping has started to wane. In an attempt to cut costs, they recently announced a 10% cut to their corporate staff. It's a sign that even online giants like Wayfair aren't immune to the challenges facing the retail industry. The future remains uncertain for this online giant. Digital Brands Group, a collection of digital-first fashion brands, is facing declining sales and mounting losses. They warned investors they might not stay afloat, hit hard by the economic downturn and changing consumer habits. Failed acquisitions left them saddled with debt. Even digital-first companies face retail industry challenges. Rite Aid, a familiar sight on street corners across America. They've been struggling for years, facing competition from larger rivals and online retailers. The pandemic actually hurt Rite Aid. Fewer doctor visits meant fewer prescriptions. Supply chain disruptions and rising costs have taken a toll. Rite Aid lost $600 million last year. They're sitting on over $3.2 billion in debt. That debt is a major drag on their profitability. The future looks uncertain for this once thriving pharmacy chain. Victoria's Secret, once synonymous with lingerie and glamorous fashion shows, has fallen out of favor. Their narrow beauty standard feels out of touch today. Controversies, including ties to Jeffrey Epstein, haven't helped. They've been closing stores and laying off employees. Efforts to revamp their image continue, but the future is uncertain. We have 99-cents-only stores, known for its bargain basement prices. The company has been struggling with rising costs, supply chain disruptions, and increased competition. Their business model is particularly vulnerable to inflation. When the cost of goods goes up, it's difficult for them to raise prices without alienating their core customer base. They recently made a deal with creditors to trade debt for equity. This move will give the company some breathing room, but its long-term future remains uncertain. Even in the world of discount retail, it's tough to make a profit when costs are rising. Best Buy, synonymous with electronics. The company faces declining sales as consumers buy electronics online. The pandemic surge in demand for electronics has waned. People have already bought new laptops and gaming consoles. Best Buy now faces a slowdown in consumer spending. The company warned of slower sales growth due to weaker demand. Even the biggest players in tech retail feel the pinch. The future remains uncertain for Best Buy. Remember Toys R Us, the once beloved toy store chain that went bankrupt in 2018? Well, believe it or not, Toys R Us is back. Sort of. Today, Toys R Us exists primarily as a website and a handful of smaller stores within Macy's locations. The company is still grappling with many of the challenges that led to its downfall. In the age of tablets, smartphones, and video games, traditional toys just don't hold the same appeal. It remains to be seen whether Toys R Us can recapture the magic that made it a childhood staple. The future remains uncertain for this iconic brand. The Children's Place, a go-to destination for affordable kids' clothes. The company has been struggling with declining sales, store closures, and increasing competition. Birth rates have been declining in the United States for years, which means fewer customers for children's clothing. In an attempt to stay afloat, the Children's Place has been closing underperforming stores and focusing on its online presence. But it's unclear if these efforts will be enough to offset the challenges facing the company. The future remains uncertain for the Children's Place. It's a tough time for retailers catering to a shrinking customer base. Capri Holdings, a luxury fashion conglomerate. They own some of the biggest names in high-end fashion, including Michael Kors, Versace, and Jimmy Choo. Capri Holdings has been struggling with declining sales, store closures, and supply chain disruptions. The decline in international tourism has hurt luxury spending. In an attempt to cut costs, Capri Holdings has been closing stores and laying off employees. They've been trying to boost their online presence and appeal to younger consumers. The future remains uncertain for this luxury fashion conglomerate. Tailored Brands, synonymous with men's suits. They own some of the biggest names in men's formal wear, including Men's Wearhouse and Jaws, a bank. Tailored Brands has been struggling for years, facing declining sales and a shift away from traditional formal wear. The rise of casual workplace attire and the decline of traditional office jobs have taken a toll. The COVID-19 pandemic led to a sharp decline in demand for suits. In an attempt to stay afloat, Tailored Brands has been closing stores and laying off employees. They're trying to appeal to a younger, more casual customer. The future remains uncertain for Tailored Brands. Chuck E. Cheese, a popular destination for birthday parties and childhood memories. The company has been struggling with declining sales, store closures, and increasing competition. The COVID-19 pandemic forced Chuck E. Cheese to temporarily close its locations, dealing a major blow to its finances. In an attempt to stay afloat, Chuck E. Cheese has been trying to revamp its image and improve its food offerings. They've also been enhancing their entertainment options. But it's unclear if these efforts will be enough to lure back customers. The future remains uncertain for this family entertainment center chain. It's a tough time for businesses relying on in-person experiences. Our final entry is Brooks Brothers, synonymous with American menswear. The company has been struggling with declining sales, store closures, and a shift away from traditional formal wear. The rise of casual workplace attire and the decline of traditional office jobs have taken a toll. The COVID-19 pandemic led to a sharp decline in demand for suits. Brooks Brothers filed for bankruptcy in 2020 and was acquired by Authentic Brands Group and Spark Group. The new owners have been trying to modernize the brand and expand its online presence. They're also trying to appeal to a younger, more casual customer. The future remains uncertain for Brooks Brothers. So there you have it, 15 retailers facing an uncertain future. The retail landscape is constantly evolving, and even the biggest companies are vulnerable to disruption. These aren't just names on a list. These are businesses that employ thousands of people. If you're a loyal customer, visit their stores while you still can. Thank you for watching.